Hey, what's going on, guys? Dante Trades here, and in this video we're going to be talking about how to determine risk when trading futures with prop firms or trading futures in general. So we're going to learn how to calculate risk using the S&P ES and the NASDAQ NQ contracts. Now this is going to apply to all contracts that you want to trade, but these are the examples we're going to go over in this video. And understanding risk is the most important thing for trading consistently and profitably. If you don't understand risk, then you're obviously going to heavily struggle. We're going to be breaking down what contracts, ticks, points mean in future trading and how to calculate your risk across minis and micros and what minis and micros really even are. And also we're going to be going over a secret risk cheat sheet formula that I created to save you time and stress when calculating your risk. I am a six-figure trader. If you want a 100% free futures trading course, link to that will be in the description. So jumping right into it here, what is a tick or a point? A tick is the smallest movement a product can make. So for example, on the ES, that's going to be a movement of 0.25. So on the ES, if the price moves from 5,100.00 to 5,100.25, that means the price went up by one tick, right? Very simple. And same thing, if the price moves from 5,100.00 to 500 to 5,000 0.9975, then the price moved down by one tick. And just to show you a little bit better here inside of TradingView, if you look at TradingView here, you see the price right here on the ES is 6,711, and you see if I go up one tick to 6,711.25, then that is up by one tick. If I go down by one tick, the price is 6,710.75. So literally up one tick, down one tick. 0.25 is the smallest measurement that the ES can move, and that is what a tick is. So 4 ticks equals 1 point on the ES. So again, here, if we go on the ES, we see the price is 6,711. And if we go up 1, 2, 3, 4 ticks to 6,712, that is 1 point. And from 6,712 to 6,713, that's 2 points, right? So that is what a tick or a point is. And each point on the ES is actually worth $50, and each tick on the ES is worth $12.50. It's very, very simple because if you each tick is worth $12.50. So if you multiply $12.50 times 4, you get $50. So very, very simple math there. 1 point is 4 ticks, and 1 tick is worth $12.50. 1 point is worth $50. Very, very simple concepts there. So understanding contracts. So each contract has a value per tick. This value depends on what product you're trading. So again, on the ES, 1 tick equals $12.50. So if the price moves against you by 1 tick, then you lose $12.50 per contract. So let's say, for example, on the ES, we're just going to open up a long position here where the price is. And again, this is the weekend, so the price is not moving. So we have $6,011 where the ES is. And if the price goes 1 tick against me, then I would lose $12.50 if I was trading with one contract, right? And if the price goes against me by 1 tick, then I would lose $12.50 if I was trading one contract. And if the price went in my favor by 1 tick, then I would gain $12.50 if I was trading one contract. So 2x contracts equals $25 per tick, because again, it's very, very simple. If you're using one contract, it's $12.50. So if you're using 2 contracts, it's $25. If you're using 4 contracts, then it's $50, right? Because you literally just multiply the price per tick per contract. So again, if you're using one contract, it's $12.50. If you're using 2 contracts, it's $25. If you're using 4 contracts, it's $50, etc. You just literally just multiply it. So the more contracts you use, the higher the dollar risk. So now let's talk about how to calculate risk. So the formula for risk is going to be your stop loss times the tick value times the contracts. And I'll show you an example. So if you have a 3-point stop loss, so let's say for example here, we go and you can see here, this stop loss is 1 point. You see inside of TradingView, you see it says 1 point. Let's just say we're gonna move this down to a 3-point stop loss. So let's just move this all the way down to 3-point stop loss. So we have a 3-point stop loss, 3 points equals 12 ticks times 1250. That's $150 per contract in risk that we're taking on for that trade. So if we took on 2 contracts for that trade, that will be a $300 risk. And if we took on more contracts, then we would take on more risk, right? So I just created a risk chart to save time so you don't have to do all this math. So this may be a little bit more simple for you guys here. So let's say, for example, again, on the ES, we have here, you can see the ES risk chart. So we have the points here in this column, we have the ticks here in this column, and then this column is a contract. So this will be if you trade in 1 contract, 2 contracts, 3 contracts, 4 contracts, all the way up to 10 contracts. So we wanted to trade, let's say for example, you always want to know exactly how much you want to risk. So let's say for example, if I wanted to risk, I don't know, $400 or something like that on a setup. And let's say for example, I see a trade here, like I want to risk, let's just say, I just want to risk, I don't know, like up to down here, let's just say 3.75 points. So I just go here, 3.75 points, and I want to risk roughly $400. So I know for that setup, for the risk that I'm setting here, if we go below this stop, I don't want to risk more than $400. So I know this here is going to give me 2 contracts. So for that risk, it would be $375 on 2 contracts, right? And if I wanted to risk less here, then I can see for 1 contract that would give me $187.50 worth of risk. So this is just a very quick way to know how many contracts you can trade for the setup that you're seeing. So let's say, for example, again, if you just see any kind of like setup in the chart and you're like, okay, cool, I want to risk 5 points, 6 points, or whatever it is, you can just go and see, okay, cool. If I want to risk 6 points and if my setup that I see is 6 points and I don't want to risk more than, I don't know, $400, then I know I can only trade 1 contract on the ES and risk about $300. So again, this just makes it really, really simple for you to know how much you're risking. And as you grow over time and you start to like usually trade similar size setups like me, I usually am risking from like 3 to 6 points. I kind of know how much risk I can have for how many contracts. But again, if you don't know, this is just a really quick sheet to look at that. And if you actually want access to the sheet, you can actually go into the free course that we have and you can download it there so that you can actually trade using this sheet, right? So again, if you want the sheet, I'll just upload it for free to the course, and I just showed you how to use that. Now we're going to talk about deciding between minis and micros. So every product has a micro version with a 10 times smaller tick value. So for example, we have the mini ES, which we talked about. That's the normal ES. And this is $12.50 per tick. But then we have something called the micro ES. It's 10 times smaller. So it's not $12.50 per tick, it's $1.25 per tick. So yeah, so you want to trade micros for a smaller risk and minis for larger positions. Just know that the trading fees are a lot more with micros. It's significantly more. So if you trade the same position size on micro, you're talking about a 200 to 400 percentage difference when it comes to the trading fees. But you just want to switch between them depending on the stop loss and size. So let's say, for example, in this case here, let's just say we wanted to, if this was a trade we wanted to take, let's say we wanted to enter this trade right here, and we wanted to get out stop below this at $7 and excuse me at 7.5 points or 30 ticks. And let's say, for example, we only wanted to risk $200 on this trade, right? So we want to stop out below 7.5 points, but we only want to risk $200. Well, you can actually see if I go on the ES chart here, for 7.50 points, so 7.5 points. If I trade 1 contract on 7.5 points, so you can see here 1 contract, 7.5 points, I'm going to be risking $375. So if I only want to risk $200, then in this case, I can go to the MES, which is the micro. So again, I went from on my risk sheet, this is the regular ES here. Now I went to the micro MES chart, right? So again, for 7.5 points, now I can risk, 5 contracts of the MES and only be risking $187, right? So you can see in this case, in some cases for a certain setup, if the risk would be too much for one contract here, then I can trade the MES, which is a smaller contract, and get the right setup for the correct amount of risk for the setup that I'm looking for, right? So this is where trading the micros comes in handy when you don't want to risk too much for the trade or the setup that you're seeing. But again, just make sure you use this wisely, because micros are totally fine, but they're just quite a bit more expensive when it comes to fees and stuff like that. It's nothing crazy, but it is more expensive than the normal ES, right? So again, that's why you will use micros. And also too, people like to scale in and out of trades using micros, which we're not going to get too much into in this video. So now we're going to talk about the mini versus the micro example for the NASDAQ or the NQ. So the NQ moves 1 point equals $20 on the NQ, on the regular NQ. So 1 point is $20 on the NQ. And for the micro, again, is just 10 times smaller. So on the micros, 1 point equals $2. Now let's say we have an average stop loss of 12 points. So on the mini NQ, which is just the regular NQ, 12 points times 20 is $240 worth of risk. And then you can just see that on the sheet here. So if my stop loss was 12 points or 48 ticks, however you like it, with one contract, you can see here that my risk would be $240. And then the micro will be the same exact thing, but just 10 times smaller. So instead of $240, it'll just be $24 of risk per contract, right? So same exact thing with the NQ. So adjusting for different stop sizes based on the setup. So again, let's just go to the NQ chart. And let's just say we have a 15-point trade here. Let's just say we want to get in here, and then we're going to put our stop just randomly here, 15 points. Let's just say 15 points, right? So this is our trade that we want to get into here. So let's just say we have a 15-point stop loss with 5 micros, and that's going to be a $150 risk here. So 15 micros, you can see here, 15 micros here, 5 contracts, $150 risk. But let's just say you wanted to risk 300 on this trade instead of 150. Then in this case, on the same trade for the same amount of risk, or excuse me, the same amount of points, you can just use 1 mini instead, and that would give you a $300 risk, right? And you would pay less fees when you use the 1 mini instead of like 10 micros. So again, if you're going to trade the same size, in this case, I wouldn't like use 10 micros. I would use 1 mini because it's the same size and you are going to be paying less fees in this case. So in this case, if you wanted to risk $300 on this trade, this 15-point trade, then you will use 1 micro instead. So you just again adjust between micros and minis to match your desired risk, and make sure it's about your desired risk and not how much money you want to make. I'm much more focused on how much I am risking when I'm trading than the actual profit target. Of course, I have my profit targets, but let's say, for example, if I enter a trade and things are moving very quickly, usually I would more focus on my stop loss. So if I get stopped out, I don't lose anything. Then worst case, if your profit target hits, you can just, it'll just keep running in your favor. So again, just know that you want to more focus on how much you're risking more than how much you want to make, because how much you risk is way more important. And me, I'm a one-to-one risk to reward trader. So there you go. And prop firm contract limits. So prop firms cap the contract size depending on what size eval that you've purchased or what size account that you have. So for example, on Take Profit Trader, on the combines, they max out at 6 contracts. So if you try to trade more contracts than that, your order will be rejected. So just be aware of that when it comes to trading with prop firms, etc., etc. So now I'm going to talk about setting up an ATM order with Tradovate. So ATM order stands for Advanced Trade Management. This automatically sets the stop loss, take profit, and break even trailing rules when entering a trade. So this just helps you maintain a consistent risk to reward ratio across every single trade, so you just aren't scrambling. So again, here I'm just going to quickly show you how to set up an ATM order. You're going to log into Tradovate here, and then you're going to come to the top, and you're going to go to where it says ATM, and then show in. Usually I'm going to use ticks. Now they don't have points. I normally do like to trade in points, but they don't have a points option. So it's totally fine. But just like, say for example, if you want 3 points, each tick, 4 ticks equals 1 point. So if I want 3 points, 3 times 4 is 12. So I'll put my take profit as 12 here, and then my stop loss as 12 here. Or whatever your normal take profit or stop loss is, I would just put it here as some safe default. And then once you actually place the trade, you can adjust it. And then stop loss type, we just do stop. And then name, we'll just do like standard stop or something like that, right? And then you'll just hit save. And then when you every time you make a trade, you just want your standard stops to be on. So what's going to happen is if you click an order, you can see when I hover over it, you're going to see these dotted lines here. I can't actually place the trade because the market isn't open. But what's going to happen is you see how I can drag this here. Every time you place a trade, it's just going to automatically put a stop loss and a take profit based off your ATM order here. And then actually once the trade is actually placed, then you can actually just drag your TPs or stop loss, etc., etc. I just can't do it here now, but just see how you can drag this here. You see this dotted line that comes on the screen there. You're just going to be able to drag them here, just so when you place a trade, you won't have to manually create like 3 other orders every single time you place a trade, especially if you're a scalper, things move kind of fast. So it's a really, really helpful thing you want to do when it comes to placing trades and managing risk, so you don't make any huge mistakes, right? So final thoughts. Understanding risk is essential. Ticks and points are just measurement units. Contracts define your dollar per tick risk exposure. Use the risk chart to size trades efficiently, as I showed you, and easy. Adjust between minis and micros to stay within your risk tolerance per trade. You want to use ATM order templates to maintain consistent risk and risk to reward ratios. And if you have any questions, you can drop them in the comments, and like and subscribe again. And also as well, you can get a 100% free futures trading course in the comments. That's it for this one, and I'll see you guys in the next video.